So you can put together a bond portfolio. It will be risky, but you can put a bond portfolio together today that yields very easily 12%. Very easily. Year to date, I've got my cheat sheet here. This doesn't even include today. Year to date, high yield bonds through today are down 13%. Investment grade corporate bonds are down 19%. So you look at something as simple as bank loans, which is the top of the capital structure. They're floating rates, so you don't have to worry about interest rate risk. They're not going to take a loss. They've went from a price of 100 down to a price earlier, couple months ago, of 94, and now they're at about 96. These are securities that are very likely to go back to 100. You're getting a yield of 5 or 6% with almost no risk, and the propensity of those bonds to go back to par is extremely high. So there's a forward return, say 1 year, that could be 10, 11, 12%. And there's far, far less risk there than stocks. I think a very optimistic case on stocks would be a return of 12 to 15% over the next year.
So that was Jeffrey Gundlach, CEO of Double Line Capital and a very successful investor. He basically just said that you can easily make about 12% return with a bond portfolio, and you'd be taking much less risk than investing in stocks. So in today's video, let's break down what he's talking about here. We'll take a look at bonds and how they work, and I'll show you some different ways to buy bonds so you can potentially make 10 to 12% return that Jeffrey has mentioned. Now, when something sounds too good to be true, it often is. So I've looked into the bond market to see if Jeffrey is right, and for the most part, he is. Because interest rates have gone up so much so quickly, fixed income assets such as bonds are relatively more attractive than stocks right now. So if you can make a 12% return in either the stock market or the bond market, then why not shift your portfolio to mostly bonds today? Generally, bonds are seen as lower risk and lower volatility than stocks, but I'll get into why that might not be a good idea later in the video. First, let's take a look at what bonds are. A bond is basically a form of debt. You can think of it as a fixed rate loan. You basically have a creditor lend money to a borrower, and let's say this is for $100. The borrower pays interest to the lender, and this will be at, let's say, 5% a year, and that would be the coupon of the bond. And after, let's say, 5 years, the debtor then returns the initial $100 principal back to the lender. So that's why every bond will have a coupon and a maturity. The coupon is basically the annual interest rate, and the maturity date tells us how long before the principal is returned to the lender. The thing is, once a bond is initially sold, let's say it has a face value of $100. If the maturity date is, say, 5 years from now, and it matures in 2027, from now until then, the original buyer of this bond, which is basically the lender, can go onto the secondary market and actually sell this bond if they don't want it. And the price that they can sell the bond at will depend on interest rate changes, because if the coupon for this is, let's say, 5%, then that means the borrower pays $5 every year to the lender until 2027, and then they'll pay back the $100. But let's say we have interest rates jump up, and now interest rates are at 10%. So the same issuer of this $100 bond before will now have to sell new bonds with a coupon of 10% instead of 5%. Well, the coupon rate doesn't change for a bond, so nobody would want to buy the previous bond at $100 face value if it's only paying 5% when they can just buy a new bond that's giving them 10% interest per year. Because buying a bond that pays 5% interest is not as attractive as a bond that pays 10% interest. So for this bond to be able to sell in the market, you need to sell it at a discount, maybe at $95 instead of the face value of $100. And the reason is because if you pay only $95 for this bond, when the bond eventually matures, you are going to get paid back $100 from the debtor. So you would make a $5 gain from this, and you need to compensate for that because you're getting paid a lower interest rate. Now, the same thing is true if interest rates were to go down. If a new bond were to pay, let's say, only 2% interest, then the value of this initial bond will be worth more. So you can initially buy the bond for $100, but sell it for like $103, $104, and you can get out of your bond position and sell at a profit if the new interest rate environment offers lower rates. Here's an example. Ally Financial used to have a coupon rate of 1.45%, but more recently, Ally Financial has a much higher coupon of 4.7%. There is no reason why you would want to buy the previous bond at a lower coupon if you can just buy the new bond of Ally Financial, unless you're able to get the previous bond at a very steep discount. And that's what's happening with this company. You can see the previous value of the bond was at 100, which is par, and then over time it's gone down, and the last price is about 72. So this almost looks like a stock chart. The price of a bond is inversely correlated with interest rates. And this is what Jeffrey was saying when he mentioned like how bond portfolios are down.
Investment grade corporate bonds are down 19%.
Which is why bonds as well as stocks have both been hurt this year. Now, that being said, bonds are still less risky. They have lower volatility than stocks, and they've gone down less. So Allied Financial's bond is down about 30% year to date. But if we look at the stock for Allied Financial, we can see it's down almost 43% year to date. So that's the decision investors have to make between bonds and stocks. But because interest rates have gone up so far already, lower bond prices is actually a good thing for future bond investors. Because let's say you buy the previous Ally bond and you're only going to get 1.45% coupon, but the bond is expiring next year. You would still get the 1.45% or $1.45 coupon between now and next year, and you're also going to get paid back the $100 initial principal. So if you're able to buy this bond at $90, let's say, and you're able to get 101.45, then you've basically just made a return of 12.7%. So bonds, just like stocks, have a market price and they can go up or down depending on what buyers and sellers are willing to pay for that risk. Now, one of the easiest ways to buy bonds is through an ETF, such as the Vanguard Total Bond ETF, which includes bonds from companies like Ally Financial, Amazon, AbbVie, and a bunch of other corporations, as well as government debt. Now, the ETF is down about 15% year to date because it holds a lot of bonds that have relatively low coupons compared to where bond rates are now. But going forward, as those older bonds mature, this ETF will continue to buy newer bonds at higher coupons. So as long as interest rates don't move any higher, the returns from now should start to creep upwards for this ETF. The yield to maturity here for the ETF, which is the average expected return of each individual bond, will increase until we get like a 4 or 5% yield to maturity. In terms of which ETFs I like, in Canada, the Vanguard Canadian Corporate Bond Index, VCB, is a pretty good fund because it focuses on corporate bonds, which tends to pay higher coupons than government bonds. Right now, you're getting a yield of 3.13%, not bad, and the ETF is down 10% year to date, which is not too bad. So if you're looking for some kind of Canadian bond fund, I think this is a pretty good one to go with, and the expense ratio is just 0.19%, which is fairly low compared to its competitors. Now, if you're worried that interest rates are going to go up a lot higher, or if you know you're going to be needing the money in 1 or 2 years from now, what you can do instead is buy this ETF here, VSC, which is an ETF full of short-term corporate bonds. Now, because these are shorter duration bonds, the coupons aren't going to be as high, which means the yield is lower. You can see just 2.76%. However, you have lower interest rate risk. Because the bonds mature so quickly, if interest rates were to go up, the fund will more quickly saturate itself with those bonds with higher interest rates. So that's why the year-to-date return is not as bad, like you've only lost 5%, which relative to the stock market and most other bond ETFs is not a bad return in 2022 so far. So just like other bond ETFs going forward, because interest rates have gone up, you do stand to make a positive return with this ETF. And you're much better getting in now than say a year ago when this ETF was at 24.54. Now, in the US, you have a few more options. For example, you have BND, which we just looked at earlier. This is the Vanguard Total Bond Market Index Fund. It has a mix of government bonds as well as corporate bonds. And you can see the year-to-date return, not very good. So Jeffrey was saying a lot of bonds are down this year, 15, 20%. And if your portfolio held bonds like the one in this ETF, then you would be down the same amount. However, going forward, you will likely see positive returns, maybe 10%, 12%, like he was saying, if you have a bond portfolio like this. Now, a little bit more on the risky side, something that I would consider if I were buying US dollar-based bond ETFs is LQD. This is from iShares, and it's basically just investment-grade corporate bonds. Because companies are higher risk than, say, the United States government, this is why the yield on this ETF is a bit higher than BND. This is at 2.83%. Whereas BND is at 2.23%. However, you also have more risk, which is why you can see the year to date it is down 21%. So if you buy this now, which is at one of the lowest points in the last 20 years, going back all the way to 2003, and you just hold on to this, then not only will you be getting the 2.83%, but also this yield is likely to go up over time, and you're likely to capture some capital appreciation as well. As you can see over time, this ETF has been going up, and right now we're just at a very low point. But as the price reverts back to its average, I expect eventually this ETF to go back to above $110 or even $120 per unit. So you have the potential to make a lot of capital gains there. And that's what Jeffrey was alluding to when he said a lot of bonds are down to like 90 cents on a dollar, 95 cents on a dollar, but eventually they're going to go back to 100 at maturity. And that is equivalent to the price of this going higher in the future. Now, if interest rates were to go up another 1% or 1.5% over the next 6 months, I would actually expect this ETF to go down before it goes back up. So if you're worried about that, then you can consider the Vanguard Short-Term Corporate Bond Index Fund. And this is like the Canadian short-term bond portfolio where the yield is lower because these are shorter duration bonds. There's less chance of the company going bankrupt because you're only borrowing money for like a 1 or 2 year period. But you're also less susceptible to interest rate hikes. So this one's only down 7.38% year to date. And then, of course, other than just buying ETFs, you can also buy individual bonds, but that's a little bit harder to do. You'll have to look at your own research platform or brokerage account to figure out what kind of fixed income options they offer. So for example, I have TD Web Broker here. To get into the fixed income section, you can go to Research, under Investments, Fixed Income. I used to buy a lot of high yielding bonds, and if you click on this high yield link, it'll open up another window, and there will be a list here of all the current high yield bonds that TD is offering. For example, you can get an Air Canada bond maturing in 2029, and your yield to maturity is about 7.5%. A Bombardier maturing in a few years, you can get about 8.9% total yield, and that's accounting for the coupon, which is already pretty high, as well as the discount that you're getting if you buy the bond right now, in which you'll pay 94.6 cents on the dollar. So that's about a 5% discount. Now, if you want to go higher risk, there are companies like Sherritt that is trading at a huge discount, 71 cents on the dollar, but that one is rated CCCH. So yes, you're getting an 18.6% yield to maturity, but the risk you're taking there is if the company goes bankrupt, you could be losing your principal. So for me right now, I would look into more like investment grade bonds like BBB or AA, something around there. And if we look under featured portfolios here, there is a BBB 5-year corporate ladder that TD has set up. And you can take a look at this to see what kind of options are available right now. So for example, for this Granite bond paying a 3.87% coupon, we're looking at Granite REIT Holdings, which is a real estate investment trust that operates warehouses and industrial properties. So they're pretty well run, and if you buy their stock or their REIT, you can get roughly 4.5% yield. So that's pretty good. Plus, you get upside potential. So if I were investing in Granite REIT, I'd probably just buy the stock instead or the REIT. And the only exception here is if I knew I needed the money in like a year's time, where the bond's going to mature in 2023, and I just want a 5 or 6% return from now until then this would be a better buy today than the REIT because the REIT can always go down. So if you're likely to make 10 or 12% with a bond portfolio over the next year, then why not just invest in that and not have to deal with the risk or the stress of investing in the stock market? Well, the reason why I'm mostly invested in stocks is because of the historical track record of long-term returns. Every time the S&P 500 has gone down 20% like it has this year, most of the time 1 year later it has been positive, also 2 years later and 3 years later. So this is a table of all the times the stock market has entered a bear market since 1950, and the average return that you would get is 29% so far. And this is why I'm still more bullish with stocks than I am with bonds. Even though you have a good chance to make like a 12% return with a bond portfolio, I think you can make a much higher return with a stock portfolio. But the thing is, you have to be invested in stocks now because it is very likely that you're going to make a 30% return or higher in the stock market. And I don't know if 3 years later, if you can make that kind of return in the bond market. Now, there is a wide variation here, of course. As you can see, during the dot-com crash, you were actually negative after 3 years. And after the 1973 bear market, the stock market was only up 7% after 3 years. So you do run that kind of risk, but at the same time, you can see some of the other figures here are quite high. If you have a 10-year or longer investment time horizon, I would still have most of my portfolio in stocks, but now is not a bad time to start looking at bonds and to start adding some fixed income into a portfolio just to balance things out. Because at this point, stocks can go lower, but at the same time, if interest rates are going up, then bonds can also go lower. So you have risk either way, which is why being diversified is something that you can do right now that will lower your overall risk moving forward. So thanks a lot for watching. Good luck with your investments, and I'll talk to you in the next one.